If you can master these 5 price action strategies, then you're going to be able to make a ton of money in your trading. I'm literally going to be giving you and handing you the cheat codes you can use to become highly profitable. In fact, at the end of this video, I'm going to be sharing with you some tricks, some things you can use in order to give yourself an unfair advantage over other traders. And the only way that this video is going to be effective is if you watch it in its entirety. So if you haven't subscribed to this channel yet, do so right now, because we release videos just like this on a consistent basis. And for those of you that are subscribed, welcome back, and let's get started. So let's talk about the first strategy. The first strategy we're going to be talking about is what we call trend trading. This type of trading strategy works best whenever you're at a market situation where the market is either trending up or whether the market is trending down. So whenever you see a series of what's called higher highs or lows that are getting higher and higher and higher and higher as well, that is what we call a trending market. This type of strategy does not work well whenever the market is consolidating. So in a market such as this, whenever the market is consolidating, this type of strategy would work less effectively. So what you want to find is you want to find a market or a chart or a currency pair that you're looking at that is either creating higher highs, higher lows, or lower highs and lower lows. So whenever you see a market that is trending, you'll always see that the market doesn't go straight up. It always moves in what's called a cyclical pattern. It's always moving up and down, up and down, and up and down. So while the market is indeed trending, it's always having these impulses and it's always having these retracements. It's always having an impulse, always having a retracement, or in other words, a pullback. So what you want to do is in situations such as these, you want to capitalize on the move in the direction that the trend is moving, in this case, uptrend, but you want to find an optimal entry to where you can get the maximum amount of pips and also endure the smallest amount of drawdown. So where would we enter on this trend here? The way we would want to do this is we wouldn't want to chase the trade and enter while the price is already moving up. We would want to wait until the price has exhausted and created what's called a pullback. These are the areas where we would want to enter our trades at, because what most people do and most beginner traders, whenever they see the market is moving without them, they see that the market is pushing higher, higher, and higher, higher. They get what's called FOMO and they want to enter a trade at the highs or near the highs because they've already saw that the price has essentially left the station without them and they don't want to get left behind. This is not an ideal area to enter. Why? Because the price could create a pullback and allow this trader to get stopped out. So what's a better way to enter this trade is you wait for the price to continue to go up until it creates a pullback, and then you find an area based on technicals of where you would want to enter your buy. So let me give you an example. Here's how we would do it. We would go ahead and grab the trend line tool, and you can find this tool over here on the left. Click on the little arrow and you have the little trend line tool. You click on that, and then what you would do is you would create a trend line to connect the lows as best as possible. You want to try to connect the lows, and whenever the price approaches that low next time in the future, notice the line is approaching the trend line. That is at a moment where you would want to enter your buy and be able to capitalize and ride the wave in the direction of the entire main trend. The trend is your friend, so you want to trade with the direction of the actual trend. So let me give you an example of how this works in action. So what you would do is you would find an area where you see a relative low, such as this, and you would grab your trend line, again, from way over here on the left. You would grab your trend line, you would mark out your first point, and then you would draw your second point at the next low. So let's say we have found this as our next low. You would connect 2 points in order to start your trend line. Once you have the 2 points connected, what you would want to do is you want to make sure you extend the trend line into the future. Why? Because we're going to be using this as a reference to where the point might react in the future. So what you can do is you can just manually drag it all the way to the right, or this little thing will pop up, and what you can do is click on the little gear icon, and then you can click where it says extend right line. So what's going to happen is it's going to extend this all the way to infinity. So this line is going to continue all the way to infinity. So if you are someone who always forgets to extend your technicals to the future, to the right, I would just go ahead and click the gear icon, extend line right, and then it'll automatically extend it to the future for you. So now that we have our 2 points, what we're looking for is we're looking for the next time, the next opportunity where the price might react and go touch this trend line again. And when it does, that is when we're going to enter our buy position. So let's go ahead and play this out. Price approached the trend line. Now is a point where we would enter the trade. Our stop loss must be below the trend line, and we can put our take profit wherever we want to put our take profit. So in this case, let's just do a simple 1 to 2 risk to reward ratio. 140 pip stop loss, 280 pip take profit. So in this case, if the price goes in our favor by 280 pips, the take profit is hit. So take profit is hit. So what we would do whenever we're doing trendline trading, because it can be a bit subjective, you want to try to encapsulate as many points as you can. And you would also want to try to get on the most outskirt edge of the trend lines. So in this case, this trend line can do 2 possible things. This can be a possible trend line, or this can be a possible trend line. So whenever you're drawing trend lines, just know that sometimes it can be a bit subjective. The best thing you can do in order to give yourself the highest probability is draw both scenarios, or even draw 2 parallel trend lines. So the reason why I've drawn 2, just to make sure it's super clear. The beginning of the trend is very clear. Everyone can agree that this is the beginning of the trend. However, the next thing, which is a bit subjective, is whether we should touch this low and then have it go through that, or whether you draw the trend line at the outermost bound, the extremes, in order to find an area where the price would react in the future. So what we can do is we can kind of just measure the difference. From here to here, this is around a 70 pip difference. And you keep going a little bit farther in the future, this turns out to be a 80 pip difference. And then something over here, this turns out to be like a 60 pip difference. So notice the farther out that the price action goes, these 2 lines are separating, and then the difference between both of these are getting wider and wider and wider. So if you decide to enter your trade on a more aggressive side, meaning on the upper bound of the trend line, you still must take into consideration that your stop loss must be at least on the other bound of the wider trend line. Why? Because if this is the actual trend line that the market reacts to and respects, you don't want to get stopped out if your stop loss is too tight. Let me kind of explain what I mean. Let's go ahead and continue this. If you would have entered on this, top trade here, this still would have been a decent entry, but you must have put your stop loss below the bottom trend line. So in this case, what that trade would have looked like if you entered up here would be, that is the entry, and your stop loss must be below the bottom trend line, which gives you a stop loss of around 100 pips. Now entering on the closer bound on the first trend line, that gives you a little bit more of an aggressive entry, which means you'll have a higher probability of the trade getting triggered, but you might be enduring a bit more of a drawdown. So this right here would be the more aggressive entry. So a little bit more conservative entry would be down here, which has a less of a probability of the trade even activating, because the price in reality might not always touch that far. It might just react and reject just a few pips above your entry. So that might be a missed trade. But in this case, if you entered your trade on the actual trend line, this would have been a nice sniper entry. Stop loss can be a bit tighter, around 50 pips or so. And then we get a lot better risk to reward ratio. In this case, we have a 4 risk to reward ratio because we had a little bit more conservative entry, a little bit farther, which allowed us to get a tighter stop loss. But the downside of this, again, is you have a lower chance, lower probability of the trade even triggering or activating. Why? Because the price might not push all the way that far. It might react a little bit prematurely. So that is a trade here, and then we would just continue. So that is the current market right now, just off of this trend. Now let's talk about another example. Here we are on Euro USD, same concept. If you see a trending market such as this, you want to be able to find the extreme lows in order to draw your trend line. So we see some obvious lows that are getting higher and higher here. So we can just simply draw a trend line. And a quick note, by the way, if you're on a Mac, you can hold Command. And what's going to happen is if you look at the crosshair, it'll temporarily enable this little magnet tool. And then this will allow you to get a pixel perfect starting point of the trend line. If you're on a Windows, I think that'll be Control. So you got to hold Control and then you can click. So in this case, I'm going to hold Control or Command and then just click. It'll automatically jump that to that area right there. And then I want to try to connect all of these little lows that you see here to get a nice trend line. So we have our trend line created. And again, guys, what we're looking for is we're looking for the initial anchor and we're looking for the second anchor point. And those 2 points are what's going to allow us to have our trend line created. So we have first point, second point, and then you would be able to enter your buy on the third touch point or in order to enter your trade. In this case, this trade went 1,289 pips in over a 3-month period, 92 days. And if for whatever reason that you missed that trade, that same trend line got respected on this area as well. So here we have another trade, another setup that hit around 580 pips in around 48 days, around like a month and a half. Now the question is, will this always work? Absolutely not, right? You're never going to have 100% guarantee in trading. It's always about probabilities. You want to make sure that you have an edge in the markets to allow yourself to either win more trades than you lose, or even if you have a 50-50% win and lose ratio, you can still become profitable if you have a greater than 1 risk to reward ratio. Let me just put this in example. Here we won one trade. Let's say this gave us 800 pips. Won a second trade. Let's say this gave us 500 pips. And our stop loss was normal, like let's say like 50 pips or so. Same thing here, 50 pips or so. So we won these 2 trades. And we're not going to be biased and ignore the next time that the price is going to touch the trend line. Because we've done it here and here, we can't ignore that the price is approaching this trend line. I know we see after the fact that this trade didn't work and this trade failed. But the point is we can't predict this in the future. So we're going to have to. If we enter the trades here and here, we're going to have to enter this trade over here as well. We can't be biased. We still have to enter the trade. And that is all about entering trades with a specific strategy. So let's say we enter the trade here. And then in this case, we had the same thing, 50 pip stop loss. And in this case, the price went straight to stop loss and we lost the trade. But in this case, what is the risk to reward ratio? We gained, so this is a 17 risk to reward ratio, meaning if we risked 1% of our account, that means we gained 17% if we hit take profit. We have a 17% gain in our entire account if we got this one trade right. Same concept here. If we got this trade wrong, we would have lost 1% of our account, but the fact that we got this trade right, we gained 10%, almost 11% on our account. So 17% plus 10%, that's a 27% gain on our entire account with 2 trades. And again, because we cannot predict the future, logically, having a trading strategy, we are going to take this trade as well. We're going to take it no matter what. And in this case, it went straight to stop loss. If we get the trade wrong, what percentage of our account do we lose? Hopefully you're saying this in your head. You're losing 1% of your account. Because if you would have got this trade right, you would have made 6% gain on your account. But in this case, we lost a trade. We lost 1%. So with a 27% gain minus 1% gain, that's overall in 3 trades, we gained 26% on our account. I hope this is very, very clear. Let's do another example on GBP NZD. Right now, I'm currently on the 4-hour chart. Same exact concept. Whenever you see the market is trending, you want to draw, you can hold Command to kind of snipe that low wick. And actually, let me go ahead and disable the extend line right. I personally don't use that because I extend all my trend lines to the right. But let's say you have your trend line drawn. You want to try to connect all of the lows as possible. We want to try to connect the lows, and we kind of see the amount of times that this price action would have got you a profitable trade. So again, recap. How many anchor points do we need in order to draw a trend line? 2. What's our first anchor point? This one here. What's our second anchor point? Right over here. This is our second anchor point. Now we have a trend line. We can draw this, and now we can enter our trade on the third point. So you need at least minimum 2 points to draw the trend line, and you would enter your trade on the third or more touches of the trend line. So we have so our first touch, second touch, our entry is here, stop loss below, and then our take profit anywhere above. Then we have our next trade here, stop loss below, take profit above. Our next entry point, stop loss below, take profit above. And then we have this trade over here, stop loss below, and then take profit above. And then the next time that the price touched this area, we still have to enter because we cannot be biased. We still have to enter. We enter the trade here, and it ends up going against us, and we've now lost that trade. So let's just say with just these risk to reward ratios, 4% gain, 5% gain, 4% gain, 2% gain. Overall, that's a 15% gain on our account with these 4 trades, minus the 1% loss that we got. So this gives us an overall gain of 14% total. And by the way, guys, even if we had more losing trades than we got right, simply because we've adjusted our risk to reward ratio, because we have a proper risk to reward strategy, you can still become profitable. So let's say this is the only trade we got right. So let's say we got this trade wrong, minus 1%. Let's say we got this trade wrong, minus 1%. Let's say that we got this trade wrong, minus 1%. Let's say we got this trade wrong, minus 1%. And let's say this is the only trade that we got right, plus 5%. So this is getting us a 20% win ratio. We lost 4 trades out of 5. This is a terrible win rate. However, overall, because we got a 5 risk to reward ratio on this trade, overall, we are net positive 1% on our account, even with a terrible, terrible win ratio. Let's talk about strategy number 2. This is what we call support and resistance trading, or in other words, supply and demand. Essentially, how this works is what happens more often than not, whenever the price approaches certain levels in the market, the market tends to react at that same level multiple times. I'll give you an example. So right now, I just kind of drawn here at around the $98 price point. I'm currently on US oil. So what you'll see around this bound, in this scenario that I've drawn, the price action is having trouble breaching this point. So whenever you see a scenario where the price action is having trouble breaching what's called a resistance area, or in other words, you can think of it like a ceiling, that is an area where you would be able to find entries, trades to enter in the down direction, to enter what's called sells, or in other words, to enter what's called a short. So you would enter a short, you would enter a short, you would enter a short. Now, on the other end of that, if you see an area where the price is having trouble breaching the lows, this type of area would be what's called a support area. And this is an area where you would want to enter a buy position. This is where you would want to enter buys. So let me give you an example on the actual chart itself. So you can see right here that the market had trouble breaching these lows right here. So you draw not a line. In order to draw these support and resistance areas, is you want to draw it as a zone. So you have your zone created because the price isn't going to magically react and reject at a single exact price point to the exact dollar and cent. It's going to be somewhere in that relative area. So once you have your zones created, you'll notice the price is having trouble breaching. And then what you can do is you can enter your buy position, making sure that your stop loss is below the zone. A lot of brand new traders, when they trade and they especially see a price moving in the direction without them, they end up getting FOMO and they don't want the price action to leave without them. So for example, in this scenario, you see there's a bunch of green candles and the price was initially at 67 and now it's at 75. A lot of traders get FOMO and they want to enter here. They want to enter right now where It's not at an ideal position. So they enter their trades here. And now if this trade was wrong, guess what? Their stop loss has to be all the way down here. Why? Because if this trade did end up going against them and touch it again, then this just would have been another unnecessary lost trade if the stop loss was way up here. So in order to protect your downside, your stop loss must be below the zone. So this is not the ideal area where you want to put your entry. You want to put your entry at the zone, and you want to be patient. You want to wait for the market to come to you, and then you want to strike when the market is at your level. So same exact concept at a resistance area. So same exact concept here. So we see the price is having trouble breaching this area right here. So this is an area where you would want to enter what's called a sell. So you can enter your sell position going in the down direction over here. Same exact concept here. This is what's called a resistance area. So next time that the price approaches this area, guess what? You want to extend this all the way into the future. The next time that the price approaches this area, you want to look for an area where the price might react. Same exact concept here. Next time the price comes here, you want to look for an area where the price might react. So if you did enter a buy, let's say you entered a buy back here, this would be a very decent area to take profit. Let me show you another example. We are currently on Euro AUD, same exact concept. If you ever see an area where the price is having trouble breaching, this is an area of support. So these would be areas where you would be able to enter your buy positions. And if for whatever reason that you missed that, the next low that you saw, you draw the zone and you want to extend it to the future, and that could have been the next entry for your buy. So this area right here, this is a very strong level that you want to look at in the future. And in terms of a resistance, this would be an area where you would want to look to take profit or close your trade if the price ends up reaching this area again. Why? Because the price had trouble breaching this area previously. So if you do enter a trade anywhere within the zone, you want to look to take profit at this zone right here. And by the way, guys, this works in any single time frame, guys. I'll go to Euro CAD. So for example, right here, we'll go to the weekly time frame. Again, guys, the only thing you want to do is you just want to mark out any of the highs that you see. You want to extend these bad boys into the future because, again, we want to use these as reference points where the market might react in the future. So that is a resistance area where the market has reacted. This right here, the market has reacted multiple times. So you would have had multiple potential entries on EuroCAD on the weekly time frame, and even then going all the way up to recently on this trade over here as well. And looking for a buy, we have a strong support zone right here. And these are opportunities to enter a long. These are long buy opportunities. The main thing that you must keep in mind is whenever you're drawing support and resistance, whenever you're trading this, you want to make sure that you have your stop loss below the zone. You want your stop loss to be on the other end, the other bound of the zone, because you want to protect your downside so you don't get stopped out prematurely. Same exact concept here. You want to have your stop loss. If you were entering a sell, you want to make sure that you have your stop loss above the zone. Same exact concept here. If you had drawn your resistance area here, you wanted to make sure you had your stop loss above the zone. The market comes up here again. You want to make sure that you have your stop loss above the zone. Again, does this work 100% of the time? Absolutely not. But the point is to give yourself an edge where you get more trades right than wrong. I've already explained to you how you can combine risk to reward ratio and win rate and still have a profitable strategy, even if you get more trades wrong than you get right. And speaking of trades that are wrong, this brings me to our third strategy. What happens in a scenario where you are wrong, where the market doesn't respect that support or resistance zone that you've drawn? You can still make money. And I'm going to show you, this is what we call our third strategy, what we call our breakout trading strategy. So how does this work? So let's say you have a resistance area just like this. So I'm connecting all of the highs. I want to encapsulate as many of these little highs as possible. And what I'm doing is, this would have been an area, and by the way, I'm on gold XAU USD on the 1 hour chart right now. So if you want to enter a sell, you can enter your shorts on any of these zones, any of these zones. These are all money-making trading opportunities, except this one right here might have fizzled out, hit stop loss, break even. But what's going to happen is if you see the market clearly broke your zone, clearly closed above the zone. Notice this closed above the zone for 1, 2, 3, 4, 5, a few candles. This shows you can have an area where the price is now broken out of this resistance, and now this resistance has now potentially turned into a support. So on the break, waiting for the price to come back and approach the zone, this is an area where you would now want to enter in the opposite direction. Because remember, down here we were entering a lot of sells, entering a lot of shorts. Here you would want to enter what's called a buy. You want to make sure that you have your stop loss below the zone. And now you have your entry created, and now you are in a long. You're in a trade that is going in the up direction. So this is an example of a break and retest. How we trade these breakouts is we wait for the price action to cleanly break above the zone, and we then continue to patiently wait for the price action to retest, to touch that zone again. And when it does touch it, that is our entry. Our stop loss is below the zone, and then we continue our take profit. And that is how we trade what's called a break and retest. And by the way, guys, this works in any asset, whether you're trading gold, metals, Forex, whether you're even trading crypto. For example, we'll go to Bitcoin, BTC, USD. Let's go to the daily time frame over here. Let's say you were marking up your BTC, USD, your Bitcoin chart, and you notice that this is a strong, respectable area. This was a support, resistance, resistance. And then what ended up happening, that same exact area, as the price was respecting it as a resistance, the price has now turned into a support one time, a support a second time, a support a third time. These are all small day trade opportunities that you can take. For example, this one right here, 8% gain. This one right here, 5% gain. This one right here had a 23% gain. And imagine if you were trading Bitcoin with leverage, this would be a massive, massive, massive gain just off of this one trade over here. Now, I've shown you a couple examples on support and resistance, and I remember the first thing I showed you in this video was trendline trading. So let's do an example of that as well. So let's go to USD JPY. We go to the 1 hour chart, and let's say we were doing exactly what we were doing on our first strategy. We were just doing normal trendline trading. So let's say we were going ahead and marking up our trend line, and we're trying to connect all the lows as much as possible. And we have our trend line created, our first anchor point, second anchor point. We have our first trade that we entered to buy on, gives a lot of pips. And let's say we entered another trade here. It went against us. And the same exact concept with strategy number 3, the break and retest, we notice that the price action broke through the trend line. And now what we can do here is we can wait for the retest. Same exact thing as a support and resistance, except we're doing the same exact thing with the trend line, because initially we were entering a buy, we were entering long trades, buy positions. But now that the price action has broke below it, now we're looking for a sell opportunity, but we're entering our sell exactly whenever the price kisses our trend line. And now we have our short, we have our sell position, and now we are in our trade looking for a sell, looking for a short. This is what's going to allow us to get a small stop loss, a very accurate sniper entry in terms of risk to reward ratio, and it'll allow us to capitalize on the entire move on the way back down. Now, the fourth strategy that we're going to be talking about is what we call chart pattern trading. Let me explain what I mean by this. The market will often create patterns that occur in the market over and over again. These are repeatable market patterns that you'll see occurring on a consistent basis in the market. So if you can identify them, if you can spot these patterns, these will allow you to find very high probable entries that allow you to make a lot of money if you can spot these properly. Let me explain what I mean. So the first one that we'll talk about is a simple, either a double bottom or a double top. Let me explain what I mean. So right here, you'll notice the market created what's called an extreme low. Or in other words, this is the lowest point that the market has been in a while. So this has created a clear bottom. So you would want to identify this as a zone. So once you've identified this as a zone, you could look to enter another entry, a buy, at an area where the price reacts at this area again. And if the market had trouble breaching this area, this is what's considered a double bottom. And then this will allow you to capitalize on this entire move to catch a bunch of pips. So same exact concept here. you can see that the price had created an extreme low here. Let's say a low right here. But if you look in the past history, the price hasn't reached this area in a long time. So you draw this zone as a zone to identify. And then the next time the price reaches it, in this case, it took the price 21 days from this day to reach this moment again. This is where you would strike and enter your buy position, because what's actually happening in the market, the psychology behind it is, you see the market is creating a high, a low, a lower high, a lower low, a lower high, lower low, lower high, lower low, lower high, a lower low, a lower high. Yet this low was not a lower low. This low had trouble reaching this area. So you could enter a potential buy here, or if you notice that the price had trouble breaching this area, this shows you a potential sign of reversal. Now you can look for entries going in the opposite direction, looking for a buy. So these are all buying opportunities. But if you were able to identify and capture this first low over here, you would have capitalized on what's called this double bottom over here. So that is the first pattern. We'll talk about the double bottom or the double top. And actually the next one we can talk about, I literally just see it right now. We can talk about the head and shoulders pattern. So essentially what the head and shoulders pattern is, it's at a moment where you see the price creating a high, a higher low compared to the previous one, and we see a higher high compared to the previous one. And then the next low isn't always necessarily a higher low, but in fact, what ends up happening is this low ends up reaching roughly the same price level as the previous low before the next high is now lower than the previous high. And this will allow you to get a signal to enter a potential sell and ride the wave back down. So hopefully me drawing this, you guys can already see somewhere on my screen right now where this has occurred. If you don't see it, I can identify it for you really quickly. So what I do, I generally go over here and I click on where it says head and shoulders, and this allows me to get the tool pulled up so I can properly easily see it. So this is our first low. This correlates to this little point over here. And now we're trying to identify the next high, which is over here. Our next low is here. Our next high is here, which is our head. And now we're completing the head and we're marking our next low, which begins the right shoulder, which is roughly the same price level as the left shoulder. And this is at a point where we can now enter our sell, enter the trade in the down direction. So the trade with this pattern would be from the right shoulder going down. This little line that you see right here, this little horizontal dotted line that you see right here, this is what we call the neckline. And I'll give you a hint. You have a stronger probability that the pattern is going to work in your favor if this line is tilting downwards, or if this low is either equal or lower than this previous low. So it is a stronger pattern if this low is lower than this one, or if this is at an equal point of this one. But if this low was higher, something like this, it would still be considered a head and shoulders, but it wouldn't be as strong. So the strength of the head and shoulders depends on how low the second point is to complete what's called the neckline. And in this case, the right shoulder should ideally be at a point where it's roughly equivalent to the left shoulder. So this first hump creates what's called the left shoulder, then we create the head, then we create the right shoulder, and we enter our trade on the right shoulder. Hopefully this is crystal clear for you guys. I'll give you guys another example. Right now we were on Euro AUD. Let's go to GBP NZD. Completely different pair. So we look over here, same exact concept. So I'm going to get my head and shoulders tool, and then we see our low here. We see our high here. We see our low here, which is completing the first shoulder. Now we create our head, and then we create the neckline, then we create the right shoulder, and now this is where we enter our trade. So now our trade is going in the down direction. So how do you identify that a head and shoulders is being formed? So you can essentially attempt to predict that this would be a shoulder. the way you would predict it, the only way that we would be able to even tell is if this low, again, guys, this is the most important point that we need to consider, creating a head and shoulders pattern so we can enter while it is forming. We want to be able to identify this stuff while it's forming. So at first, we have our normal low, we have a normal high, we have a normal higher low, we have a normal higher high. So this is just a normal uptrend, right? But then if it's a normal uptrend, we would expect this next low to be a higher low, just like it was doing in the past. But this low was not a higher low. Instead, what ended up happening was this low was a low that's equal to their previous low. And the fact that it was equal, this should light a light bulb in our head and say, hold on, this might be a head and shoulders pattern. So at this point, roughly around, let me hit the little replay tool, roughly around this candle. At this candle is where we should identify and say, okay, hold on, this price went low here and now it's rejecting back up. This gives us enough information to determine where we want our right shoulder to be. And our right shoulder should be roughly around this level over here. So we can enter what's called a potential sell. We will definitely want to make sure our stop loss is above the left shoulder. We can have two take profits. Our first take profit can be the neckline, just like you see here. And the second take profit can be somewhere below. But once you have your trade set up, we will go ahead and continue. And that is the trade with a head and shoulders pattern. Now, the next chart pattern we'll talk about is what we call the triangle patterns. Now, these type of patterns are a little bit difficult for some people to identify and find as they're forming, but let me kind of explain the psychology behind what's actually happening. So the first one we'll talk about is what we call a symmetrical triangle. Essentially, what the price action is actually doing is the price action is squeezing in between two bounds before the price action explodes beyond the bounds, either in the direction going up or the direction going down, either to enter a buy or a sell. Now, the things with the symmetrical triangle is the only issue is you really won't have an idea of which directional bias that you should be looking to trade in until after the price breaks through the pattern itself. So you'll see the price is essentially squeezing and waiting for the price action to actually squeeze either below or squeeze either above. Now, this price action in action is right here. You see that the highs are getting lower and lower and lower. The price action is squeezing. And then here, they're getting higher and higher and higher. And the price action is squeezing towards the up direction as well. So what's happening to the price action? It's a low, a high, a low, a high, a low, a high, a low, a high, a low. And then the price action finally breaks. And you see that the price has exploded. Now, one way you can capitalize on these moves is, first thing you can do is you can enter trades within the bounds. You can enter sells within the triangle. You can enter buys within the triangle. You can enter buys within the triangle. Now, as the price action is squeezing into a point, what you can do to capitalize on the squeeze, because again, you don't know which direction it's gonna explode in. So what you can do is you can enter a sell, leave that sell open. You can enter a buy, leave that buy open. And by the way, guys, this only works with a broker that allows you to hedge. In this case, we have a sell and we have a buy. We have two trades that are open in the opposite direction. We're making money on this trade on the way down. We're making money on the way down, and then we're making money on the way up. But as the price goes higher and higher and higher, we have to understand that this trade right here is losing money, It's becoming less and less profitable as the price is approaching higher and higher and higher. It'll get to a point where this trade will end up in a small loss, let's say a 1% loss, but now you have now capitalized on this trade with your stop loss below the zone. Let's say you close this trade with a 1% loss and this trade is still running. This trade is currently in a 3% gain. So just by setting yourself up properly, and rewind this if you're confused a little bit, you're entering a sell here and it's continuing to run. You're entering a buy here and you're continuing it to run. You're letting this first trade, because again, you don't know which way the price action is going to pierce. You're going to let this trade hit your stop loss, this trade is going to continue to run. You have a 3% gain. You lost 1% on the first trade. So now you have an overall 2% gain, but you're not going to close this trade and you're going to allow this trade to continue to run. This is what's going to allow you to capture a massively high risk to reward ratio. This gives you a 9 risk to reward ratio. So you've gained a 9%, but you lost 1%. This gives you an 8% gain. Now, to go on a little bit more further and a little bit more advanced, if you are someone that is looking at fundamental analysis, you can clearly tell which way that the market is going to react, because this reaction was created through some sort of fundamental analysis news. Within the span of 4 hours, the market went from here all the way to here in one day, 388 pips. So if you are paying attention to what's happening in the Great Britain pound and the Japanese yen, this is a very easy trade, and you don't have to enter this losing trade over here, because if you were paying attention to fundamental analysis, you'll already have a directional bias to look for long opportunities, buy opportunities, and you can capitalize on the way up. That is a way you can reduce the amount of losses that you get if you simply pay attention to fundamental analysis. Now, the last chart pattern we'll talk about is what we call an ascending triangle. Essentially, what the price action is doing is it's doing the same thing. It's squeezing in between two bounds. An ascending triangle, we have a strong resistance area, and the price action is essentially knocking on the door while the buyers are in control. So the price action has a tendency to pierce through that resistance zone and go in the direction it was already knocking in. So for example, we have an ascending triangle. I'm currently on Euro NZD on the 4-hour chart. We see a resistance zone here. And what's happening with the price action, it is creating higher and higher highs. So the price action is squeezing in between these two bounds. So what's the price action doing? Creating a high, a low, high, low, high. And once the price action actually pierces it, we now have a potential entry to enter a buy on what's called the break and retest. Notice we're combining what I taught you in the last strategy. We're waiting for the break and retest, and now we enter a long. So our buy position would be here, or alternatively, our buy position can be here, and we can trade based on fundamentals in the direction that the price is actually going. We see that the price is squeezing upwards, so we should be looking for a buy, a long directional bias. Now, same exact concept over here. I'm on the same chart on the 1-hour chart. Currently in the recent price action past couple of days, you see the price action had trouble breaching this resistance area right over here. The price action was creating higher and higher and higher highs. The price was trending up, and it was squeezing in between these two bounds constantly, and the price action pierced through it, came for the retest, and there's a very nice buy opportunity that gave you around 100 pips on this trade in around 22 hours. So if you were trading this with a 1-lot trade in around 22 hours, this is around $1,000 trade in around 22 hours. Now, the fifth strategy that we'll talk about is what we call confluence trading. This is when we combine multiple technical factors in order to pinpoint and identify a strong area where the market might react. Why does this work? This works because there are traders out there that trade only using trend lines. There are traders out there that trade only using support and resistance zones, accumulation distributions. Traders that only trade using exponential moving averages or simple moving averages. There are traders that trade just using fibs. There are traders that trade just break and retest. There are traders that trade so many different ways that if you combine multiple factors, you'll be able to get a high probability entry where the price might go in your favor. Let me kind of explain what I mean. So let's say we are looking at this price action right here, and we notice that the extreme high was right here, and the current extreme low is right here. So what we can do is we can draw what's called a fib. We can add a Fibonacci retracement at the first point at the relative high, at the next point at the relative low, extend that into the future. So now we have certain levels on how far back that the price could potentially retrace to. So essentially what the Fibonacci is telling us is if the price reaches this area, the price has essentially breathed in around 23%, or in other words, it has retraced around 38%, or it retraced halfway, retraced 61%, 70%, and then all the way it retraced all the way back 100% of the move that it made. So these are areas where traders look to identify potential areas to enter a trade. So one thing we can do is we can find which of these areas aligns with other technical factors in the back. I see a clear support area, which has created what's called a somewhat of a resistance here. So this is a strong key level. This is a very nice, clean zone of interest. I would be interested in entering a sell on the 38 fib if the price ends up reaching these wicks where the price had trouble breaching below the wicks, breaching below, and the price had trouble breaching back above it. So this is a strong area where you want to enter a potential sell. And then there you have it. Let's go ahead and do another example. So right now I'm on Euro GBP on the daily time frame. So obviously we can clearly see one of the relative highs was here, relative low was right here. So as this high and low was created, once this pullback was starting, we could then identify where we want to draw our fib from the high to the low, this low right here, extend it into the future, and then we see where do any of these points align. So there is alignment at the 61 fib. There's not really any clean alignment on the 50 fib. There is indeed clean alignment on the 38 fib. And then where this price ended up reacting was exactly on the 38 fib. And now we enter our sell on the fib and the zone. And this trade netted us 139 pips. Because remember, guys, if someone wasn't trading fibs, they were only trading this support and resistance, the break and retest, this is a very valid, solid trade to enter. But if someone was trading only fibs and they weren't trading any zone trades, they would be looking to enter trades on the 38, maybe the 50, or even the 61 or the 78. So these would be areas where they would want to enter a trade. But the fact that we are combining multiple factors, this gives us a higher probability, a higher win rate to get us an accurate trade. Now I'm going to go back to Euro USD, one of the first examples I've given. Remember this one, we were talking about the trend lines. This very first strategy, if you combine this very first strategy also with Confluence trading, the fifth strategy, you'll notice that once we have our first touch, our second touch, our third touch, we see that the price has created a nice support level. So the price lines up perfectly with this intersection right over here. So as we see, let's say the price is here. The price is here, and we see that the price is creating a nice support. And now we see the price is approaching the trend line at the support. This is a perfect area to enter your sniper entry for the buy and then have the price go in your favor. That is how we use Confluence trading. I'm going to give you one last example to really drill this in. So right now I'm currently on Euro USD. So we see the trend is obviously trending downward. So are we looking for a buy or are we looking for a sell? We should be looking for a sell because the trend is trending down. So the first thing we can do is we can draw our trend line. We see that the price action is reacting here, reacting here, reacting here, reacting here, and reacting here. What is the next thing that we see? Next thing that we see is the price is creating a nice little support area right over here. So we would grab our rectangle tool and then draw our support area right here. So we already see two things intersecting right here. The next thing we can do is we can see if there's a fib that aligns. So let's get the fib tool. You can either draw your fib here to here or this to here. Let's kind of check both. The first one all the way to the lowest point lines up with the 50 fib. And let's say we drew the fib from here to here as well. This one lines up with the 61 fib. So we have four things right now. We have a trend line. We have a zone that has now been broken. So we're looking for the potential break and retest. Then we have our 50 fib. Then we have a 61 fib. All these four things lining up over here. And what else do we have? If someone was trading moving averages, for example, I just now enabled the SMA and the EMA, the 50 SMA and then the 50 exponential moving average, the EMA. And then if these two bounds act as a dynamic resistance, if these two lines are approaching the same exact area as well, we can also consider those as a confluence as well. So let's go ahead and see what the price action will continue to do. The red one is lining up nicely. The blue one is lining up nicely as well. Okay, so now we have both of the SMA and the EMA both lined up within the zone. So now altogether we have a trend line, we have a zone, we have a break and retest of the zone, we have the 50 fib, we have the 61 fib, we have the EMA, we also have the SMA. We have so many different confluences that are lining up in this specific area over here. And then what we would do is you can go ahead and enter your potential short, your potential sell limit. You can enter your sell somewhere in that zone, making sure that your stop loss is above all these different technicals that we mentioned. Stop loss must be above the zone, must be above the trend line, must be above the SMA and the EMA, must be above the fibs that we're talking about over here. So once you have that set up, now you are in business. Trade got activated, and now we are in profit. So that is how you use the fifth strategy, Confluence trading, in order to get yourself really high probability setups. And listen, guys, the only way that any of this stuff will even work is if you practice. You have to try to get at least 1% better. You don't need to have a 1% gain on your account every single day. You just need to get 1% better every single day, because if you're working on yourself, you're working on your craft, and you're always analyzing charts, you're trying to identify areas where the price is creating these type of confluences, and you can identify these patterns, these zones, these trend lines prior to them occurring. The faster you can identify them, the more you'll be able to find profitable trades. And that is how you make thousands upon thousands upon thousands of dollars. Guys, you don't need to get every single trade right. You shouldn't even expect to get every single trade right. In fact, you should not expect to get a trade right. You should not expect your trade to get wrong. You shouldn't cry or worry or have any emotions or be emotionally attached to any single trade. You should know that over the course of many trades, if you track your progress, you'll be able to find out and have numbers identified that you can tell yourself that, okay, I know over the course of 100 trades, on average, that I win 75 trades and I lose 25 trades. Or you can even say to yourself that, okay, I know on the course of 100 trades, I usually end up losing half, and then I end up winning the other half. But then you can tell yourself, okay, but I know on average, my risk to reward ratio that I'm hitting on every trade is 2.6 risk to reward ratio. And with those metrics alone, you know you can become profitable. So the first thing you need to do is you need to identify what your win ratio is. You need to identify what your risk to reward ratio on average is. And then you need to repeatedly do the same thing over and over and over and over again. Don't ever miss out or skip on any trade because you think it doesn't feel right. If you have a strategy and you're going to use that strategy repeatedly over and over and over again, you must take every trade opportunity that presents itself with your strategy. Because if you cherry pick certain trades and you kind of eliminate the other trades, you're not going to know over the course of long term whether your trades are going to be right or wrong. Because let's say you cherry picked one trade and you didn't take another trade, but the other trade ended up being right, but you skipped it. You're not going to know at the end of the day, at the end of 100 trades, whether that strategy is actually going to be profitable for you or not. Don't get discouraged. Start off small. Start off with the first strategy that I showed you. Then start off with the second strategy. Then slowly move on to the third. And then as you get more experience, then you can move on to the fourth and the fifth strategy. And then once you have enough experience under your belt to combine most of these, then you'll be able to find high probability setups consistently and finally be able to grow your account. That is the name of the game. You're not supposed to get 100% of the trades right. You just need to do the same thing over and over and over again and build yourself these great habits. If you found this video valuable, drop a like on this video. Let me know in the comments below. Type in the comments whether this was valuable for you or not. If you aren't subscribed to the channel yet, be sure to subscribe. Share this video right now. Hit the share button. Share the video to someone that you feel will find this useful. So again, if this is useful for you, thank you for watching this. Take care, and I'll catch you guys in the next video.